Jacob Solutions, ticker J, is a company that goes under the radar for many investors, and they specialize in providing consulting, technical engineering, scientific, and project delivery services for the government and private sectors, mainly in the United States, Europe, Canada, and India. The company is also one of the top 500 companies, so they are located in the S&P 500 with a market cap of just under $17.5 billion. Over the past year, the company is up by 4.69%, and over the past 5 years, they are up by 44.18%. They are a very steadily growing company with very little or almost no volatility at all. One of the reasons why we like Jacobs so much is because of their diverse portfolio. They provide their services to companies in varying sectors such as infrastructure, national security, energy and environment, health and life sciences, space, and cities and places. And this means if something was to happen with one of these sectors, the company would keep a steady flow of cash from all of its other sectors. The company also has most of its customers based in North America, UK, and Europe, and only 9% are based in other countries. This means that factors such as wars in the Middle East and Ukraine won't affect them as much or only very little. Another thing we very much like with Jacobs is that most of their customers are companies in the S&P 500 such as Intel, Lilly, and Pfizer, which are all very stable customers. Now, in 2014, Jacobs' margins were sitting at 7.8%. From 2017 to 23, their margins were sitting at 10.8%, and today and into the future, their margins should be sitting at 13.8 and above percent. And this is thanks to their transforming to less volatile and higher value services and solutions. Now, something we want to see from a company is their growth. And so if we jump to our stock valuation spreadsheets and plug in the ticker J for Jacobs and press enter, we can jump to pillar number 3, which is the revenue growth over the past 5 years. And here we can see that they have been growing their revenue at a rate of 5.9% every single year, growing it from $12.7 billion in 2019 to $16.4 billion in 2023. A very decent and a very stable revenue growth. Now, jumping to pillar number 4, we can have a look at the net income growth over the past 5 years. And here we can see that on average, the company's net income was decreasing at a rate of 2.4% over the past 5 years. But if we have a look at the years 21, 22, and 23, the net income has increased from $477 million to $665 million in these 3 years. So it's not all that negative. Now, moving to the final pillar, pillar number 5, we can have a look at the free cash flow growth over the past 5 years. And the free cash flow has been increasing by a whopping rate of 25.53% yearly. And year over year, it has grown by 14.12%. So it is obvious that they are growing, although it seems like 2024 wasn't the best year for them, as most of their growth is lower than their 5-year average growth. Jumping to their quarter 3 earnings presentation, we can see that their revenue is up to $30.6 billion, so 6% year over year, and that their operating profit is up by 7% year over year. Now, if we jump to pillar 6, we can see that their profit margin is actually lower, sitting at 3.78% than the 5-year average profit margin, which is sitting at 4.34%. And so their higher operating profit is probably thanks to the huge increase in free cash flow from 2022 to 2023. We also want to have a look at their PE ratio, and it seems like they are currently overvalued compared to their earnings. Their current PE ratio is sitting at 27.64, and the 5-year PE average is sitting at 24.32, which is closer to the 22 we want to see. We can also have a look at the price to free cash flow, which over the past 5 years, we can also have a look at the price to free cash flow, which was sitting at only 13.11 in 2020, at 16.88 in 21, and in 2022 and 23, the company wasn't doing so great. But currently it is sitting at 21.25, which is very close to the value we want to see. So it seems like they are currently trading fairly compared to their free cash flow. On tip ranks, they are currently a strong buy, with 8 analysts rating them as buy, only 2 rating them as hold, and 0 rating them as sell with a 13.52% upside. So on average, they are set to reach a value of $158.75, which is about $20 higher than their current trading price. Regarding their 2024 outlook and summary, their adjusted earnings are set to be sitting anywhere between 1.54 to 1.58 billion dollars by the end of the year, which is 9% higher than the 1.44 billion in 2023. And their adjusted earnings per share are set to be 10% higher than in 2023, so anywhere between 7.85 to 8.5 dollars. Now take into account that the adjusted earnings per share is something else than the raw earnings per share. So if we jump to our stock screener, we can see that the current earnings per share is sitting at $5.06. And if we jump to pillar number 1, so the 5-year PE ratio, and scroll a little down, we can see that the earnings per share has indeed been increasing from 2021 from 3.2 to 5.30 in 2023, and currently it is sitting a little lower at 5.06. Jacobs also pays out dividends, and their current dividend yield is sitting at 0.83%, and they have a dividend payout of $1.16 per share per year, and a very low trading free cash flow payout ratio of only 17%. And this very low payout ratio allows them to do things such as increase dividends in the future or buy back shares. And so if we jump to pillar 7, we can see that Jacobs has actually been buying back their shares outstanding, so decreasing the shares outstanding. In 2019, the shares outstanding were sitting at 138 million, and in 2023 they were sitting at 127 million. Currently they're sitting at 124 million, which means that an average decrease of 2.07% year over year. And when a company buys back shares, it's good as it essentially means that you as an investor will own a larger percentage of that company with years to come. We can also have a closer look at their dividends. So we already know that their 5-year free cash flow payout ratio is sitting at only 17%. But now we can also see that they have been steadily increasing their dividends throughout the past 5 years. So in 2019 it was sitting at only 66 cents, and currently it's sitting at $1.16, which means that they have increased their dividends by almost 100% over the past 5 years. Their 5-year dividend growth is sitting at about 10.76% yearly, and year over year they have increased their dividend by 8.91%. And finally, jumping to the ninth pillar, a very important metric to consider when buying into a company, and that is the long-term liabilities over the 5-year free cash flow negative dividends to be below 5. And this essentially tells you that Jacobs or any company generates enough free cash flow to pay off all their long-term liabilities while raising and paying out their dividends. So this ensures that the company doesn't get into debt. And we can see that this ratio for Jacobs is sitting at 1.43, which means that they can pay off all their long-term liabilities in about 7.5 years, which is awesome. Now, they have been increasing their long-term liabilities slightly over the past few years, but as their free cash flow has also been increasing, I wouldn't be too worried about that. And now we can jump to calculating their intrinsic value. So first, jumping to the Graham's formula revised, we will take the 5-year average earnings per share sitting at 4.66, the base PE sitting at 7, the 5-year growth estimate predicted by analysts at 12.71, the growth rate multiplier set at 1.5, the average yield on A corporation bonds and the current yield on A corporation bonds, and we will get an intrinsic value of $113.63, which is actually 23% lower than the current trading price, showing us that Jacobs doesn't have that strong earnings per share compared to what they are trading at. But we also have a few more models to go through. So let's jump to our discounted cash flow model. And here we will evaluate the free cash flow of the company. So we will take the free cash flow over the past 5 years and calculate the average growth rate to be sitting at almost 30%. Now the analysts predict a growth rate of negative 4.79% over the next few years, and as I want to be conservative, I will calculate a growth rate of 0% over the next few years. Now plugging in 0%, I will calculate the future free cash flow. After that, I will plug in a discount rate at 6%, and I will calculate the present value of that future free cash flow. I will then sum all of that up, add cash and cash equivalents, subtract total debt, and get an equity value, which I will divide by the shares outstanding. and get a price intrinsic value of $148.39, which is still $8 higher than the current trading price, showing us that even if Jacobs was to not grow their free cash flow at all over the next years, their intrinsic value would still be higher than their current trading price. Next, we want to compare Jacobs to their peers. So we will jump to the multiples valuation. And here we will compare them to Bach and CACI. So we will take these companies' current stock prices and divide by their earnings per share to get their PE ratios. We will then average out these PE ratios and multiply by the current earnings per share of Jacobs and get an intrinsic value of $142.58, which is only slightly higher than the current trading price. And this shows us that Jacobs is probably fairly valued within its industry. And finally, moving to the dividend discount model. And here we'll take the dividend payouts over the past 5 years and calculate the average growth rate to be sitting at 11.23%. Now, as I want to be conservative, I will plug in a growth rate of only 8%. Now, when the growth rate is higher than the discount rate, which we already plugged in our discounted cash flow model sitting at 6%, the dividend discount model doesn't work. And so we have our alternative model, which bases its prediction on the stock price next year predicted by analysts and the next year's dividend calculated through our projected growth rate. So using the alternative model, we'll get an intrinsic value of $151.31, again about $11 higher than the current trading price. And now we can finally jump to the ultimate valuation, where we'll average out the 4 valuation models and get an intrinsic value of $138.98. Now the outlier here is the Grams valuation. And if we go back to the Grams valuation, we can see that we took the 5-year earnings per share, which is lower than the current earnings per share of the company. And so if we go back to the ultimate valuation, actually remove the Grams formula, we will get an intrinsic value of $147.43, which is 4.8% higher than the current trading price. And if we plug in a margin of safety of say 10%, we will get an acceptable buy price at $132.68, which is only slightly lower than the current trading price. Now to us it seems that Jacobs is currently a very fairly priced company that is set to grow its value over the next years. And with that, if you did enjoy the video, make sure to subscribe and leave a like as it really helps me out.